Okay, good. Let's go ahead and let's take a look at chapter 5. Now, chapter 5, I am not going to test you on this chapter 5 material. Frankly, I think this is a little bit old hat. I mean, this is stuff that kind of visualizes a manual accounting system. And these days, accounting systems are pretty sophisticated that a lot of this is almost obsolete. I think it's just something that this textbook chose to include in a specific chapter. I've seen many textbooks that just include this as an appendix to a chapter as sort of a point of interest, almost a formality to include that information. So I won't test you on chapter 5, but since it is part of the textbook that we cover here at Deanne's End Accounting 1A, I will go ahead and make a few comments about it. Okay, so let's just go ahead and take a look. Okay, my clicker is going to do a number on me here, not work for me for some reason. Let me try it this way. I can never figure out the logic as to why it decides not to work and then decides to work. Okay, good. So let's go ahead and let's take a look. And when we talk about accounting system, it really is what we've talked about way back in chapter 1, which is analyzing a transaction, entering it into, and the approach that we took in class was with that chapter 2, year 1, year 2 example, was to enter things in a general journal, post them to the ledger, and then go ahead and enter the information, use the information in the ledger to prepare the financial statements. Now, if you're having some sort of automated system, then there would be a developer of that system that would understand the needs of the users, design the system, and then, of course, there's implementing the system. Okay. We're going to talk more about internal controls in chapter 8, okay? But internal controls basically are ways to prevent and detect errors, irregularities in the financial statements. Errors are accidental mistakes. Irregularities are something that are considered, almost intentional, potentially even fraud in the preparation of accounting information, okay? And controls could be computerized or manual. If we have reoccurring transactions that happen frequently and they're fairly smaller dollar amounts, then we'll probably use computerized controls. Manual controls, where we actually have a person going in and checking things, tend to be larger, unusual dollar amounts, unusual, infrequent transactions. We may have manual controls, and then sometimes we'll have a manual control that will come back behind and check computerized controls so that we're sure that the software, the computer program, whatever, is working as intended. Okay, now when we talk about looking at these various journals that we're going to be getting into here and ledgers that we're going to be talking about, it really is talking almost a manual system, but it may be helpful to know what some of these manual pieces are, just so you can kind of visualize what a computerized system, which most companies use these days, is actually doing as it goes through different transactions. So we're going to talk about subsidiary ledgers, and we're going to talk about specialized journals. Really is where this discussion is going, or subsidiary ledgers, and then we'll talk about special journals. Okay, now we have a general ledger, and that's really what we talked about in our discussion from chapter 2, where we were entering things in the general. General means most transactions will go through there. But you could also have something called subsidiary ledgers, and subsidiary ledgers sort of fall under the general ledger. For example, let's say we have in our general ledger the accounts receivable. Well, that title, accounts receivable on an account, doesn't tell you anything about individual customers. So we have what? We have Adams, we have Burns, we have Calero, we have Diazzo. We have all of these different individuals all the way down to Zito that constitute our customers. And when you add them all up, they would be our accounts receivable. So if Rubial Diazzo so happens to be the one that paid their bill, what we would do is we would update Rubio's account by what? By debiting the cash and then crediting the account receivable at the Diazzo level. And then what that would do is roll up into the update of the control account in the general ledger, so that we are now updating our general ledger accounts receivable. So you make entries typically in a subsidiary ledger, and then those will roll up into what we see in the general ledger. And what's in the general ledger is considered the control account. And the amount, if you were to add up everybody in the subsidiary ledger, that should do what? You add up what's the account balance in from Adams all the way down to Zito, and you add all those up, that should what? Reconcile to what we see as the total in the accounts receivable and the control account in the general ledger. Okay, so the subsidiary accounts will provide details, and from the standpoint of individual accounts, and then those are summarized in the control account at the general ledger level. Where this becomes interesting from the standpoint of an auditor like myself, if I wanted to test a client's recording of the account receivable, I would need that subsidiary ledger, because I would likely send out a confirmation to my client's various customers to see that they agree that they owe a certain account balance. So I'd probably take a sample of my client's customers, send out a confirmation saying, hey, do you owe $25,000? If I get a yes on that, that is evidence that helps support the amount of the account receivable that's reported in the general ledger, and of course will appear on the financial statements. Okay, so we've talked about the accounts receivable subsidiary ledger there a little bit. You could do the same thing with your payables, right? You have several vendors and you're going to want to make a payment to a vendor. So you would go ahead and credit the cash, and then you'd make a debit to the account payable to that specific vendor. And then that would roll up to the payable that's reported in the general ledger, the control account in the general ledger. Okay, specialized journals. Typically, the specialized journals are for frequent, recurring transactions, accounts that are affected by frequent transactions. Okay, so hopefully we have a lot of revenue that we're recording on a day-to-day basis. So we would have a revenues journal, cash receipts journal, cash disbursements journal. If we are purchasing inventory, we will have a purchases journal. These are specialized journals that capture transactions that happen on a frequent basis. Okay. Now, again, I'm not going to test you on that stuff, and a lot of that is very much sort of old hat. But what I want to show you by old hat, I mean, most companies have automated systems these days, and what they were describing there to you, which was very much a more manual system. But that doesn't mean that there's not subsidiary ledgers, not general ledgers, but not, where you're having to enter something manually over here and then post it over here. So what I want to do is go ahead and take a second here. Okay, and I'm going to stop sharing for a second. Is go ahead and take a second to give you an example of something called general ledger software. And sorry guys, please bear with me. Sometimes students say, well, why didn't you log in before? And the reason is, if I log into this system that I'm going to show you before, what will happen is it will log me off anyway before we can start class. So what I want to do is go ahead and find this thing now. Okay. 1 second, guys. This way. Okay, I just have one more thing I have to do here. Forgive me, and we'll be ready to go. This doesn't quite have the guess I can't do it from here. 1 second, guys. Sorry. Here we go. Should have done that first. Okay, here we go. Sorry. So let's go ahead and share the screen again. Okay, and what I want to show you here is an example of, really a general ledger software system in which we will make transactions into a general journal electronically and see how a general ledger software system would go ahead and then post those transactions to the ledger. And then we would have the various financial statements, income statements, statement of retained earnings, and balance sheet. We're not doing statement of cash flows here because statement of cash flows is discussed in another class. And really, statement of cash flows is something that is generated after you have already prepared your income statement, your balance sheet. From those two statements, you prepare your statement of cash flows. And so I'm not going to get into that in this class at all. And it's something that you'll see how those prepared. I think maybe by 1C, they get into that with you. Okay, but what would you do? You'd look at this transaction and it says Casey Spade, owner of this business. And hopefully you can see this okay on your screen. You may need to move your face a little closer to your screen to see it. Okay, Casey Spade, owner, invested $100,750 cash in a company in exchange for common stock. You guys, hopefully, please don't give me a heart attack here today. Okay, what would be the account that is affected if Casey gave cash to the company? She invested cash.
Assets.
We don't talk about debiting and crediting account categories. We talk about specific accounts.
Would it be cash?
Good. So we're going to go ahead. Very good. We're going to debit the cash. We're going to debit the cash for $100,750. Good. Okay. Now we have to credit something. The corporation's issuing stock in exchange for stock. So what do you want to credit? You drop down. You look at the menu of accounts. Do you see one that you want to credit here?
Common stock.
Good. We credit the common stock. Very good. 100,750. This is just like we did in the year 1, year 2 example when we're doing it using the computer now. So I recorded that transaction. Let me go back. That transaction is sitting there in the general journal. Okay, good. When we look at the general ledger, what should we see? What should we see when we look at the general ledger? Do we know what a general ledger is? What should we see when we look at the general ledger?
The
Right.
transactions that you made?
Okay, so we should see a posting, thank you, Elizabeth, to the transactions in my ledger accounts, and they kind of look like T accounts, don't they?
Yes.
Okay, so I go ahead and when I look, the software automatically posted those to the general ledger. Now, remember when we did this, when we were doing it manually on that little Excel spreadsheet, we had to go over and post those transactions in, right? Here, the general ledger software, you enter something in the general journal, it posts to the general ledger. Now, trial balance is something that is really old hat. Trial balance would be where after we had entered all the transactions for the year into the financial statements, we'd look to make sure that the balance sheet balanced. And if it didn't, we had to go and scrub and scrub and scrub and figure out what we had done wrong at some point in time that caused the trial balance to cause the balance sheet not to balance. These days, an internal control, it's a preventative control that we see in general ledger software, is they won't allow a entry that the debits don't equal the credits. It won't allow it to go through. In a textbook example, it might go through because they want you to make that mistake and they want you to go through the pain of trying to figure it out. But the reality is, in practice, the general ledger software would say, and it would keep not letting that transaction go through. And it may even give you, a dialog box with an error message saying, your debits don't equal your credits. I'm not going to accept this transaction. So we don't have the possibility of things not balancing because the software would have prevented that. Now, let me ask you something. After I make that one entry and I have these amounts in my general ledger, what will I see on my income statement? I don't want to click the income statement tab yet because I want to ask you, what should I see on the income statement? Why do they call it the income statement?
You'll see your income.
Net income,
Good. How do you calculate income?
revenue minus expense.
Good. So should you see anything on the income statement after this one transaction?
You see your income, your expenses and your assets.
I see assets on the income statement.
I mean, your income and then your expenses.
Do I have okay. Do I have any revenue?
No,
Ask again, why do they call it the income statement?
the revenue minus expense.
Because it shows net income, which is revenue minus expenses. Good. Do I have any revenue?
No,
Do I have any expenses?
no,
So I should see what? Zeros on the income statement, Selena?
yeah,
Yes.
What should I see on the statement of retained earnings? How do you calculate retained earnings? How do you calculate the ending balance? What shows on the statement of retained earnings? Beginning balance, add net income, subtract dividends, ending balance. Do I have any beginning balance retained earnings? No, she just started the business. We see there's no income. There hasn't been any discussion of dividends, so there's no dividend. So the ending balance must also be zero. What did they put on the balance sheet? Why do they call it the balance sheet? Why do they call it a balance sheet?
that's the balance.
Because it balances. Good. What balances? What balances? What things balance? What equals what? For something to balance, it's equal. What equals what?
Your debits and your credits have to balance.
Well, we already ensured that the software wouldn't let that happen. But by the time we get to the balance sheet, we're not really talking about debits and credits anymore. What do they report on the balance sheet? If you pick up a balance sheet of a company, are you gonna look at that balance sheet and say, I have no idea what they're showing me here after taking an accounting class?
Is it assets,
Uh,
assets, liabilities, and I forgot the last one. Word.
stockholders' equity.
Yes.
Okay, so good, Warren. Do I have any assets?
No, you don't.
I don't. So you don't think that when I made
Oh,
this? journal entry,
your
Stock,
comments, your
your-
sorry about that.
Okay, cash is, so what are you saying is the asset here?
Cash.
Common stock is your asset? Or
Common stock is not an asset. Common stock is stockholders' equity.
Your cash is your assets.
The cash is the asset. Good. There it is. Liabilities are 0 right now. And in my stockholders' equity, I have common stock, don't I?
Yes.
Assets, liabilities, stockholders' equity. And in this class, our stockholders' equity is only common stock and retained earnings, right?
Right.
Yes.
Okay. You'll learn more about stockholders' equity in later classes. Okay, good. All right, so let's go ahead then. We got that far. Okay, and let's go back to my general journal and let's go to my next transaction. Where's that? Where's my transaction view transaction list? And let me look at transaction number 2. And they said the company purchased office supplies for cash. If I purchase office supplies, what journal entry should I make?
Debit to supplies.
Good, excellent. I'm going to debit my supplies. There it is, office supplies. Very good. Well, I don't know why. Let me put it up there. Debit my office supplies. How much? 1250. Okay, good. And if I paid cash for those, what should I credit?
Cash.
Cash, good. 1250. Okay, record that entry. Okay, there it is. I just want to look back, see it's there. Okay, there's that debit to my office supplies, the credit to cash. When I view the general journal, what should I see?
Debits and credits of office supplies and cash.
Good. Okay, it now, oops, I wanted to look at the journal. Let me do it, general ledger. Let me do it this way. Good. So now my cash balance has come down, but my office supply account has come up. Good. Anything on the income statement, Selena?
No.
Good. Anything on the statement of retained earnings?
No.
Good. Anything on the balance sheet? Yeah,
Just assets
in the common stock.
and costs.
Yeah, that's still there. Okay, good. Okay, good. Let's do 2 more. Okay. So the company receives 15,000 cash as fees for service. Good. I want to enter that next transaction, view transaction list. Okay, there it is. Click down there. So company purchase 10,000. I don't want this office equipment one. Sorry, guys. Let me go back to view transaction list. Let's do number 4. The company received 15,500 cash for fees for services provided to a customer. Okay, good. What do you want me to do here now? If I receive cash,
Debits cash.
debit cash, good. 15,500. Excellent. Okay. What do you want me to credit if they provided service? If I provide service, Have I earned the revenue?
Yes.
Fees earned? $15.
FaceTime audio.
Okay, I go ahead, record that entry. Good. Okay, let's go back to the transaction list for a second. Okay, let's go to this transaction number 7, I guess. The company paid $1,225 cash for monthly rent. Okay, so if I pay cash, what should I credit?
Credit cash.
Good, credit cash. 1,225. Good. What do you want me to debit, Elizabeth, if I paying rent?
Rent expense.
Good. Here it is. 1,225. Okay, record that entry. Good. Okay, now if I look at my income statement, what should I see from those last 2 transactions I recorded? Why do they call it the income statement?
You should see revenue, right?
You see any income that you made?
Okay, how do you calculate net income?
Revenue minus expense.
Good, so I should see revenue and I should see that expense I recorded, right?
Right.
Okay, should I see something on my statement of retained earnings now?
Yes.
I should see beginning balance. I should add
Net income.
income. They haven't talked about dividends yet, and then that would give me the ending balance.
Yeah.
I don't know why the software didn't show it to us. I guess they want the student to put that in, but the ending balance would be 14,275. Okay, this is a student exercise, so maybe they wanted us to fill that in, but the moral of this story is, okay, just going back to how we got into this interesting little exercise, is that what we're talking about these specialized journals, and you picture this nightmare of the accountant going in and having to put stuff here and put stuff here and reconcile this. Meanwhile, we have what? We have software, and frankly, guys, these software can get as sophisticated as we like as we go through and you know, record transactions. The nice thing is that at the end of the day, the financial statements are sort of sitting there for us, aren't they? Now, we will do some scrubbing and adjusting through this process, but it's not nearly this manual, mundane manual, labor intensive, what's the word I'm looking for, kind of you know, process that you might be thinking it is from our early understandings, where we kind of did it in a manual process. However, it's important that you know, and that's why I held you accountable to knowing what, well, how do you record the transaction, debit, credit, and then how does that ultimately affect the account balances and the financial statements? Okay, question. Okay, now we talked a little bit about internal controls there, but let's go ahead and look at this some more. And I'm going to go ahead and put myself into slide mode from current slide. And you may have heard of the Sarbanes-Oxley Act, which was a federal statute that was issued in 2002, and it came after various financial crises. You've probably heard about Enron. You've probably heard about WorldCom. You know, WorldCom was really the one that finally, you know, caused the federal government to act, because what this company WorldCom was doing is they were taking things that should have been expenses and they were recording them as assets, meaning they were what? showing their net income larger, showing their retained earnings larger, showing their equity larger, thus making their balance sheet look better than it actually was. And investors were harmed by that. What Enron was doing is they were taking companies that they actually controlled, selling things to those companies they could control, but acting like they were selling them in an arm's length transaction to third parties. You're not supposed to do that. If I control a company and I sell something to that company, I'm supposed to remove that as a sale when I consolidate all of my different companies under my control. If there's sales to the companies between them, I eliminate that because that's not considered arm's length, which you can probably tell that's a little harder to understand. WorldCom came after Enron. Everyone, even Congress, could understand that. You had legislation that was introduced and passed at that point in time. Sarbanes was the senator, okay, in the Senate, okay, the Democrat in the Senate. Oxley was the Republican in the House, and believe it or not, the Republican, this doesn't happen anymore, but at that time, there was, fairly responsible legislators that would go ahead and vote across party lines to pass the Sarbanes-Oxley Act. Again, you had another act in 2008 called the Dodd-Frank Act, which was more aimed at banking issues. And what I always, warn my students about when they pass these legislations, they say, we're going to do this so that this never happens again. Ha, 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 ha. When you hear that, look out, they're going to drop a house on you. It's going to happen again. And it did. This weekend, Friday, you had Silicon Valley Bank and then another sort of regional bank. And now regional banks are facing some problems. And when you look, they pulled back in 2019, they pulled back some regulation on smaller banks, particularly in how they account for certain investments and how those investments affect their stockholders' equity. And as a result, the banks continued to do things that weren't necessarily as advisable because the regulators didn't stop them. And then all of a sudden you have the banks announcing, well, we need some capital to bolster our balance sheet. Depositors and investors start to panic and you start to have runs on banks and whatnot. And here it goes. It's sort of like, the flu. You think you're over it and then here it comes again. Okay, so they put these legislation in place in hopes that it's all a prayer that this stuff won't happen again, but it seems to somehow happen again. Okay. Now, what Sarbanes did was they created an organization called the Public Company Accounting Oversight Board. PCAOB basically is in charge of making sure that public companies get a good audit. So they write standards that are specific to the audits of public companies. And then they even come in back behind and take a look to see that auditors of public companies did a good job. What Sarbanes also did is it created civil and criminal penalties for chief financial officers, chief executive officers who engage in some sort of fraudulent financial reporting. By criminal, we mean jail. Okay. By civil, we mean fines and penalties. Okay. The other thing that came up, this ICFR, it required that all companies provide an attestation in their financial statements that they have a system of internal controls over financial reporting that will help prevent and detect misstatements either caused by error or fraud. And it also requires auditors to look at the internal control of the company and also give an opinion as to whether or not they think those controls would be effective. And there's really two objectives with internal control: reliability in financial reporting and safeguarding of assets. Now, when we look at internal control, the Committee of Sponsoring Organizations of the Treadway Commission, Treadway was the chair of this commission. This goes back before Sarbanes. This was like late 80s that Treadway was really, active in developing this particular model, which is a way of ensuring that a company will have reliability in financial reporting, but also compliance with laws and regulations, and of course, operational objectives. So that top part that I've circled here are the objectives of the company. They want to be profitable and whatnot. That's the operations part, but they have to make sure that they have reliability in financial reporting, and they want to be in compliance with laws and regulations. Now, as an accountant, as a CPA, I'd be particularly interested right here. I would have some interest in compliance, probably not as much in operations, but I still would want to maybe, give my clients some advice on how to maybe improve their operation. But I'm really, really, really concerned with the reporting, mainly the compliance also, but then the operating objectives. And what they did was they said, well, a company could, across the various levels of the company that you see sort of in this side of the cube here, okay, that we could institute a system of internal control that would be comprised of these elements. So you'd have the control environment. Control environment sits at the top. It is the most important. It is almost getting into a state of mind. It involves the board of directors, senior management, communicating the importance of internal control, having internal audits, and looking at those internal audits and seeing if the internal, by the way, we call it internal control because it's internal to the company, but it is really a culture, a tone at the top that comes down and touches all the other pieces of the internal control. Now, risk assessment is where the company needs to look, and they need to say, what are the risks to me achieving my objectives up here? Okay, so what are the risks that I won't have reliability in financial reporting? What are the risks that I won't safeguard assets? Once they identify those risks, they put control activities in place, and those control activities will help to then prevent, detect me not achieving my objectives as to reliability in financial reporting, safeguarding of assets. Okay, once I put those control activities into place, I then have to communicate that to my staff. So I have communication of what the staff's responsibilities are, and then I monitor. And often we'll have an internal audit department that will monitor to see that the controls are achieving the objectives. They will then report, and they report back to the board of directors, which is at the control environment level. We see if we need to make some adjustments. We look at our risks with those adjustments in mind, communicate, and then put the control activities in place, I should say, then communicate, and then we will go ahead and monitor. So you could almost see this thing in a circle, okay? Now, when we look at internal controls, there are always limitations, okay? One limitation is human error. Human beings make mistakes. It's maybe not be intentional, but something goes wrong and they make a mistake and they don't implement the control correctly, right? The other big limitation is collusion, circumvention of the controls. Maybe we have a control where we have a separation between the authorization to record a transaction, the authorization to record the transaction, and the actual recording. Or we separate the possession of the accounting records from the possession of the actual asset. You shouldn't have the same person who has the ability to make deposits or make withdrawals. That same person should not be able to update the accounting records, because the same person could do what? Could perpetrate the fraud and then cover it up. So you typically separate those duties. What collusion says is that two individuals who we have separated the responsibility get together and say, I'm going to steal money and you're not going to write it down. That is something that is very difficult for internal controls to prevent or detect. Now, the good news is we have ways of finding those later as auditors. And often what happens is when there's cheating and you find it, people start ratting each other out. Happens very quickly. That's why I always tell folks, don't even mess with this idea of trying to get involved in collusion or trying to get involved in fraudulent. You will get caught. Somebody's going to make a mistake. And then once they do, they start ratting the other person out like that. They'll throw you overboard for a hamburger. Okay. Okay, good. Now, when we look at cash, and cash, guys, sometimes I think students think the cash that we report on the balance sheet is just, cash that's laying around on a table. Well, it could include maybe some petty cash that we have somewhere sitting there, but it really would also include cash that is in savings accounts, cash that is in checking accounts. Those are all considered cash. Okay. Now, cash, of course, is something that everybody wants. And so it is the item that is going to be most coveted when it comes to theft. Okay. So to protect a company from cash, okay, it should be deposited into a bank. Checks and whatnot should be deposited really on a daily basis. Okay. And so we can receive cash from various sources, customers paying cash for a service or paying on an account receivable of some sort. Okay. Now, one control over cash would be the use of a cash register. Okay. That's why when you go to a store and they enter something in the cash register, that is keeping track of the cash that was received for that day, or even credit card receipts and whatnot. It's updating the counting records. They also hand you a receipt. That receipt is what? Is a control, whether you knew it or not, is a control over the fact that there was some sort of cash that was handed over the top. That receipt is also recorded in the cash register so that later on, if there's a sale listed there and it doesn't make any sense, they could potentially follow up with the customer and say, well, did you come in and purchase this on such and such a date? And there's a paper trail there, or at least electronic trail these days, that says that there was a transaction, arm's length transaction between a customer and the company. The other thing that's not listed here, I don't know if we listed, I'm just going to write it in, is something called a lockbox. Lockbox is an excellent control over our cash. Now, with the lockbox, I think that students tend to picture a box with a lock on it. Okay. What a lockbox really is a function that is offered by large banks. And what they do is they say, look, we'll give you a lockbox service, have your customers, okay, when they pay, say, on your accounts receivable, have them send the cash to us, and we will update your accounting records accordingly for you. Your account balances, not your accounting records, but your account balances for you. And then you can go ahead and take that information in a bank statement from us and update your accounting records accordingly as we collect cash on your behalf. When that happens, there's no chance that two people will collude and get together and start to try to steal the cash because it's going directly to the bank. That is really a control that companies are using significantly. Of course, cash register, you've seen those, but lockbox is another one that is frequently used as a control over cash. Okay. Also, we may go ahead and just tell our customers to pay us through an electronic funds transfer or using some sort of software. An online banking type of software is another good way of us controlling implementing controls over cash. Okay. Now, obviously, you don't want the cash laying around, guys. There's nothing, earth shattering here. So you would have what? You would have bank accounts, right? And those bank accounts could include lockbox function, could include the electronic funds transfer that we talked about. Okay. Now, we can also see a bank's statement. Okay, I'm not trying to insult anyone's intelligence. I'm sure at some point you open a bank account and you've seen a bank statement. Okay, and what the bank statement does is it goes ahead and shows all the various transactions that happen, and they typically cover a period of a month on bank statements where they'll look at deposits that have been made, disbursements that have been made. I'm sure at this point you've seen a bank statement, okay? But what I want to do is go ahead and talk to you a little bit about bank reconciliation here, okay? And with the bank reconciliation, what happens is you'll open up the bank statement, you'll see the bank statement, it'll say you have $500 of cash, whatever. But then when you look at the account balance that you have written down in your bank book or whatever, it says a different amount. And you're going to say, well, why is that amount different? The reason, and the way I like to describe this, is that there are things that have affected the correct cash balance that the bank knows about that the company doesn't know about. But there are also some things that the company has recorded that the bank didn't know about it yet when it prepared that bank statement. So what we do is we take the balance per bank and the balance per book, we adjust it accordingly, and we reconcile to what the correct cash balance should be. And that's what gets reported on the financial statements. So when we look at a bank reconciliation, okay, we're going to have various reconciling items that you can see on this slide. Okay. Now, the way I like to look at this slide is I say to myself, well, what are things that the bank knew about that the company didn't know about? And what are things that the company knew about that the bank didn't necessarily know about? So let's start with deposit in transit. So it is, the bank closes at 5 o'clock on December 31st. On December 31st at 6 o'clock, I go and I make a deposit into the night box over there at the bank. Did the bank know about that at 5 o'clock on December 31st? Not a trick question.
No.
No, they didn't know about that. So what would happen when I got my December 31st bank statement, since they cut everything off at 5 o'clock on December 31st, it wouldn't show that deposit. Meanwhile, the company was in possession of that cash at December 31st. So that would be a reconciling item that we would have to add to the bank balance to show that that should have been shown as amount in the bank balance at December 31st. And when I say to show, I would show that on my bank reconciliation. So this is something that and I like to put who knew about it. The company knew about this before the bank, right? Okay. Outstanding checks, what happens? I write a check on December 31st, but my vendor who I wrote that check to doesn't get around to depositing that check in their bank and then their bank submitting that to my bank. And none of that happens until, say, January 3rd of the next year. So at December 31st, did the bank know about that?
No.
Reflected as a check on my bank statement? No, because the bank didn't know about it yet. So that would be a reconciling item that I would subtract from the bank balance to get the bank balance to reflect the correct cash account. So again, that's something that the company would know about. Service charge is something that the bank knows about, and the bank is putting that. I probably won't fully know about that bank charge most likely until until I take a look at that statement. I see, oh, the annoying bank charge. Yeah, they charged me $2.50 to service this account, whatever it is, $2.50. How about bank collections? The bank collects money on behalf of the company in a lockbox, right? But they tell me about that collection on December 31st when I didn't know about it. I don't open that bank statement until January 1st, let's say. And so what happens? That's something that the bank knew about. I'd have to I'd have to add that to my company cash balance to get the correct balance. So same thing with service charge, I would subtract that. Errors depends on who made the error. And yes, guys, banks do make errors. Don't trust that they do everything perfectly. The classic error I like to talk about is way back in the 80s that I experienced. I went to an ATM, and ATMs were just sort of starting to emerge then as the way before everyone got in the big long line in the bank and waited to go and get your money out. Now you're lucky if you see a teller inside of a bank, or if the bank's even open, because they know everyone's going to go through the ATM. But when ATMs were first coming up, I was kind of one was intrigued by that because I hated waiting in line. So I was one of the earlier users of ATMs, I guess, at least amongst people I knew. And so I went and I drew money out, 40 bucks. It was on a Friday. I was going to draw out 40 bucks. Shows you how great of a weekend I was going to have in those days. And 2 blank pieces of paper came out. I'm like, what the heck? Okay, so I went around the corner, another ATM, took 40 bucks out, and I had money to last me the weekend. Went in on Monday and said, hey guys, I got this. Make sure you don't affect my account balance for these blank pieces of paper. They said, oh yeah, we're aware of that. And of course, when I got my bank statement, I made sure that they hadn't subtracted that. So banks make errors. Of course, companies can make errors as well. So it depends on who made the error. Non-sufficient funds, NSF. What happens? This is when you receive a check from somebody, your customer, you go to deposit that check, and you go to deposit it December 31st. Meanwhile, you find out in January of the next year that the client did not have the funds to cover that check. The check bounced, but the bank doesn't tell you about that until what? Until the next year. So even though you included that in your account balance, you should not have, because that cash wasn't in receipt of you until later on when you follow up with the customer in that next year and get that cash. So that would be something that the bank would know about first, okay? And then you would have to adjust the book balance for that. And then finally, interest income. And okay, I guess, you know, the bank tells you what the interest was that you earned for the period, but the you know, the company should recalculate that and make sure they're satisfied that the bank properly calculated the interest for whatever the deposits were for the period. Okay, good. So with that as just a very quick little understanding of what we're supposed to be doing with a reconciliation, let's just go ahead and take a look at maybe an example of a reconciliation. Okay, and let's look at this. And we have this, sorry guys, I feel like I'm fighting the center in here. Okay, but we have this Burbank company. Really? Okay, good. There we go. Okay, we have this Burbank company, and this Burbank company records reflect cash of $12,560 cash balance at November 30th. And then they open the bank statement, okay? And when they open the bank statement, okay, the bank information shows the following. Okay, which is there is a cash balance of $10.50. There's a bank service charge of $10. There's an NSF check of $90. Now, those things in green is what the bank is saying has happened. Then I'm going to go back to yellow here because that's the company. The company says that there are $3,000 check outstanding. Deposit in transit of $3,000, and there are outstanding checks of $500. So we want to reconcile these two cash balances. The bank is saying $10.50. The company is saying $12,650. What's going on? Okay, so we start to look at the balance per the company's records. So the company's records are saying that we have this $12,650, and we start adjusting it for things that the bank told us. The bank told us that there was this bank service charge of $10, this NSF check of $90. There could have been some collections that the bank made for us here that this example didn't contemplate that. So we know we have to subtract the NSF check because it bounced. We have to subtract the bank service charge because we hadn't reflected that in our books. And we get an adjusted cash balance. And when we look at that adjusted cash balance, we're pretty much saying, okay, that is actually the correct cash balance. Okay, that's the correct balance. But let's make sure as we now reconcile what we know about the books to that number. Okay, so we go ahead and we get the balance per bank. That was what we saw in the bank statement. Okay, I was trying to make that green because it's the bank statement, but for some reason Microsoft can't figure out how to make never mind. Okay, so we have the balance per bank of 1050. That's what's on the bank statement. I just write that down on this reconciliation, and now I start adjusting it for things that the company knew about that the bank didn't, which were what? The deposits in transit, the 3,000. Okay, the what? Outstanding checks of 500. I subtract those because I know that those are checks that are going to clear, and I had already mailed them at December 31st. So the accounting says you got to subtract that because that cash really is no longer in your bank account. Once you've let that check go at December 31st, you shouldn't count that as part of your cash balance. And I end up with what? I end up with 12,550, which does what? Which reconciles. I know I have now a corrected cash balance, and when I report my cash on the balance sheet, I won't report 12,650. No, I'm going to report what? This 12,550 because I've made sure that I have included all the items. The bank balance then will eventually reflect this 12,550. Of course, you know, it's a moving target. You'll probably never get a bank statement that'll say 12,550 on it unless you didn't do anything in that next month, because as we get to the next month, all these things will start hitting. And so again, you'll always have this difference between the books and what the bank is saying, and you have to do that reconciliation. That is a control over cash, because if there was something that hit the bank that wasn't in the books, that starts the investigation. Why? Why is there something that is recorded on the bank statement that isn't showing in the books? Why can't I reconcile this? You look at those items that are causing there not to be a reconciliation, and if you can't rationally explain it here by adding and subtracting, you start the investigation. And that's when we start to uncover, you know, fraud and that kind of thing. That's why I always tell folks, ethics discussion here, guys, just don't do it, man. Don't even think that you're going to think your way around some process and get away with this. It eventually is going to catch up with you. Okay. Okay, so interesting stuff. That's probably it for chapter 8. So let me turn it back to you guys. What are your thoughts on having some of that stuff on the midterm, or do you just want to stick with chapter 9 as our focus, not the midterm, but the final, and just limit it to chapter 9, now that you've seen some of that material?
Chapter 9.
Chapter 9?
Yeah.
I agree. Chapter 9.
Chapter 9. Okay. Okay, then none of what we just talked about will be on the exam, so it's there for you to look at. You see something that you think is interesting, you can look at that. I don't think that this is stuff that, you know, in any way, in fact, almost everything in here except the understanding of debits and credits, why I keep hitting you with that. I don't see that there's much in this class that, you know, determines your success on the next class, except that first stuff, the debits, the credits, and why I keep hammering you on that because that will go forward. There will be an expectation that you understand that in the next class. Okay. And how, what's on the income statement, what's on the balance sheet, what's on the statement of retainer, all that will continue to haunt you, dog you until you understand it. That weak backhand will keep being served back to some of this other stuff dealing with the inventory. And when we deal with the receivables, starting with chapter 9, not as much. Okay, but still, I'm going to test you on the chapter 9 with receivables. Okay, guys, I will see you on Thursday. If there are no questions, keep up the good work. I mean, for all my kind of, coaching up of you, you're doing very well in here. Okay, but just keep in mind, you need to continue that success going into the final. Don't fall down the final. Okay, and then you need to make sure that you are attending. I will be noting who is in class going forward. And if a person misses class going forward, I will not upgrade your midterm 1 score for a higher midterm 2 score. You will have defaulted on that opportunity. So make sure that you're here for the last, we got 3 classes left. Okay. All right, guys, have a good rest of the day. I will see you on Thursday.
Thank you, Professor.
Thank you, Professor.
Have a good one.
You too.